Good day. Welcome to another session of Hub Tutorials. Today we are going to look at bank reconciliations. What is bank reconciliation all about? Bank reconciliation is about the fact that a firm opens a current account with a bank, and it is expected that at the end of every period, a month, mostly, the bank column of the cash book should agree with the bank statement in terms of the balance. So we want to see the same balance that we have in our cash book as the same balance that is in the bank, and that is what is also supposed to mean. But then it is not always the case. There are sometimes, and most often than not, it does not agree. You see that we will know that we will think that we have maybe 10,000 Ghana cedis in the bank, and then when we go for the bank statement, you will have 11,000 or even 9,000, more or less, in the bank. Then we are going to look at what causes these differences, that we know in our books that we have 10,000 in the bank, but the bank is telling us that the amount there is not 10,000, it's a different amount. And so what we do is that we have to prepare a bank reconciliation statement to reconcile the cash book balance and the bank statement balance. And that is what bank reconciliation is all about. Now remember that when we want to operate an account with a bank as a business, there are three different types of accounts we can open. We either go for the savings account, the current account, or the fixed deposit account. The fixed deposit account usually isn't operated except you want to do an investment. Now the fixed deposit account is when you put your money in a bank and then you expect it to mature at a fixed period of time, and you will not go and withdraw such an amount unless the fixed period is due. And then the savings account usually also is an account where you make savings, and usually it does not operate with a checkbook, it operates with a savings withdrawal form. But then with the current account, there are checkbooks involved. Now most businesses operate by the current account because the current account affords you the ability to sign a check and then give to a third party to go and withdraw, and that makes business simple. You don't need to go and queue up in the bank to withdraw every amount that you want to. And so most businesses operate the current account. The current account affords them the ability to own a checkbook, which makes business very flexible. You cannot afford to queue at the bank for every small amount you want to withdraw. And so most businesses operate the current account. And so for the rest of the lesson, the focus is going to be on current accounts. Businesses that operate current accounts, they are the ones that prepare a bank reconciliation statement. And so we are going to look at, but before that, I want us to look at how the bank statement looks like and compare with how the cash book looks like. And so this is a typical example of a bank statement. We have the balance here, credit, we have debit, we have the particulars here, and then the date. This is a typical example of a bank statement. Date, particulars, debit, credit, and then the balance with a currency sign up there. And so what we do is that this is how the bank statement looks like. Now looking at the cash book, this is also the cash book. Now remember that we have 2-column cash book, 3-column cash book. Now the 2-column cash book is a cash book that has column for both cash and bank. And so this cash book here is the bank column of the cash book. We assume that this is the bank column of the cash book. And so what we do is that it is only for bank transactions. And so whatever we record in the cash book is expected to be recorded in the bank statement. And so what we do is that normally with a bank statement, the way we record items and the way we see it is a little different from the cash book. Now, when we are receiving cash, or when we have cash into our bank account, when we have cash and we deposit into the bank account, or when we think our bank account is increasing, we the business, we record it on the debit side of the cash book. But at the same time, whilst we are debiting our cash book, the bank is expected to credit the bank statement. So when we are debiting, the bank is crediting. And so a credit balance is a plus for us. whilst a debit balance in the cash book is also a plus. So a credit balance in the bank statement should be equivalent to a debit balance in the cash book. And so when the bank is debiting your account, it means that they are rather reducing your account. And that means that the equivalence of a debit in your bank account is the credit in the cash book in the business. And so we, or the accountant in the business, maintains the cash book, while the bank maintains the bank statement. And so if at the beginning of the period we have 100 cedis in the bank, our balance in the cash book should show the 100 cedis, and the balance on the bank statement should also show the same 100 cedis. And so what we are going to do is that let's assume that at the beginning of the period there is a balance brought forward of 100 cedis in the cash book. We are also going to have, when the balance brought forward is 100 cedis in the cash book at the beginning of the year, let's say January 1st, it is expected that in the bank statement on January 1st we have the same balance of 100, and this 100 will be recorded at the balance column. We have this 100 recorded here to show that that is the balance. And so in the month of January, what is supposed to happen is that when we receive a check, for example, from our customers, or so let's say check received from our customer, let's say the customer's name is Kofi as a debtor's name in our book. So if you receive a check of 1,000, the accountant is supposed to record the date, let's say January 4th, a check from Kofi of 1,000 Ghana cedis. Now, the bank, when we deposit the check in the bank on the same day, it is expected that the bank will credit the account with the same name Kofi and or the check number, whichever it is, and then put 1,000 under the credit. While we are debiting, the bank is crediting. And so at the end of the period, the balance will be 1,100. What it does, the bank statement does, is that it accumulates as and when you add up. We had 100, we just deposited 1,000, and so we have 1,100. Now, if we do a withdrawal of, let's say we go and withdraw money, let's say we withdraw cash of 600 from the bank. Now, the bank is expected to show that withdrawal of cash under the debit 600, and automatically it will update our balance to 500, because now debit is a reduction of the figure. And so for every transaction that is recorded in the bank statement, there should be a balance at the end, and the balance updates itself on its own. So let's assume that these are the only 3 transactions that we did in January, and so we have 500 in the bank. So we are trying to balance off the cash book as well. So the balance carried down is also going to be, we have 1,001 as a total, so the balance is 500, and so we have a balance brought down of 500. And you can see that this balance of 500 is the same as the balance in the bank statement. And so this is what I'm trying to mean, that at every point in time, the balance on the cash book should be the same as the balance in the bank. And we are trying to say that this is not always the case. There are a lot of factors that may cause a difference, and those factors may cause that you may have a different balance here and a different balance there. So at the end of the month, when you are posted with your bank statement, or you go for your bank statement, you will see that the balance you have in your cash book is different from the balance on the bank statement. And what do? You have to prepare a reconciliation statement to reconcile that. And so we are going to look at what is a bank reconciliation statement, basically, and what are some of the factors that can cause a difference between this bank statement balance and this cash book balance. And so that is what we are going to look at. Having understood this, we want to look at what a bank reconciliation statement is. Now, a bank reconciliation statement is a statement prepared by the current account holder in order to bring the balance of the cash book into agreement with the balance of the bank statement. As simple as that. But remember that I said it is prepared by the current account holder in order to bring the balance of his cash book into agreement with the bank statement balance. And so that is basically what the bank reconciliation statement is all about. Now, there are lots of factors that may cause the difference of the cash book, and the difference of the bank statement. And these are some of the factors that we are going to look at. We are going to look at factors that may cause a difference in those two balances. So, factors that cause a difference in the balances of the cash book and the bank statement. Factors that may cause a difference in the cash book balance and the bank statement balance. Now, there are a lot of factors that may cause a difference. We are going to try to mention a few and then see how we will use them to do the reconciliation. Now, the first one I will mention as a factor that may cause a difference is called unpresented checks. Unpresented checks. What are unpresented checks? Unpresented checks are checks that have been drawn by the bank and issued to suppliers for payment. But then these suppliers have not presented the checks to the bank for payment. And so you owe a supplier, you have a creditor, you write a check to the creditor to go and withdraw. And you know that you take your statement every month, but then you give the check to the supplier maybe on 26th of January, and the supplier relaxes and will not go and cash the money till, let's say, 7th of February. And then you took your bank statement in January and you realize that the difference is not the same. It will not be the same because the moment you write a check for the supplier, you pay off the creditor. You credit your cash book to show that you have made payment. So it was expected that that credit in the cash book should reflect as a debit on the bank statement. And because the creditor refused to go and clear that money, it will not reflect as a debit. And so your money in the bank will be the same, but then you have already shown a reduction in your cash book because you have already reissued a check. And so when this happens, the bank statement balance will be different from the cash book balance. And so that is basically what unpresented checks are about. Then we go to uncredited checks. Uncredited checks. Now, uncredited checks are checks that have been received by the business from customers or debtors and have been paid into the bank. We have deposited those checks into the bank, but the bank has refused to credit it into our account within the said period. So we have received a check from our customers. They owe us and they have given it to us. And when you receive a check from your customer, you will debit your cash book to show that you have increased your money. And you put the money into your bank, you will send it to bank, and you expect the bank to credit your account so that your balances will be the same for the two statements. Now, when you deposit into the bank, you have already debited your account, your cash book. The bank may refuse to credit it till the following month. And so when you take your bank statement for that month, you realize that those checks that you deposited into the bank were not credited by the bank into your account. And so your cash book balance will be higher than the balance on your bank statement because of uncredited checks. And so that is basically what uncredited checks are about. Checks that have been paid into the bank by the business but have not been credited to the business account by the bank. That is uncredited checks. Then the next factor that can cause a difference, we call it standing order. Standing order. Standing order. Now, a standing order is a payment. Now, a standing order is an instruction. Normally, it's a written instruction from the business to the bank. And then the business will instruct the bank to pay an expense on behalf of the business. And so you can instruct your bankers to pay your electricity bills for you. You can instruct your bankers to pay your creditors at a regular interval, depending on the percentage that you negotiate. And so once you write any note of authority to the bank, then you ask them to be paying some expenses on your behalf. We call that a standing order payment. So it is a written acknowledgement to the bank, instructing the bank to pay an expense on behalf of the firm. Now, sometimes when you do that, and you instruct your bankers, for example, to be paying your utility bills, for example, you may not know when the utility bills were released and sent to the bank, and so the utility company will just take it straight to your bankers. The bankers can just pay from your account, transfer from your account to the utility company's account without your knowledge, and you will not know. And so if you had known, you would have credited your cash book to reflect as a payment. And because you didn't know, at the end of the month you go for your bank statement and you realize that the balance has reduced, only for you to realize that there was a standing order payment that was done. And so standing orders are not done without your authority. However, sometimes they are done without your knowledge, and when they are done without your knowledge, you will not expect that your balance has reduced, but before you go and check, the balance has gone down and it's different from that of the cash book. And so standing order is another factor that can cause a difference between the balance of the cash book and that of the bank statement. The next point we want to look at is the credit transfer. What is a credit transfer? A credit transfer is simply someone putting money into your account without your knowledge. And so when a customer owes you, for example, and instead of the customer writing a check to you directly, the customer decides to transfer money from his account to your account directly. You may not be aware. By the time you go to the bank, you realize that there is a credit on your account from a customer. It has increased your balance. And because you are not aware, you didn't debit your cash book. And that credit transfer will cause a difference. And so credit transfer can cause a difference between the bank statement balance and the cash book balance, because the money came into your account directly without your knowledge. And examples of credit transfer can be even dividend payment. When you have made an investment in a company, a business that have invested in another instrument, and then they are paying dividends. The dividend can come in as a credit transfer, and you may not be aware. And so a lot of things can bring credit transfer. When you have an unexpected money into your account that you may not be aware, you will not record it in your cash book, and that will be a credit transfer. The next factor that I want to talk about is called bank charges. Bank charges. Now, once you are operating a current account, you are bound to suffer some charges. These charges are made by the bank for rendering their services. So sometimes it will be done because of a supply of checkbook to you, just as a COT or something that is done, a fee that is being paid on your account by a business. Now, the bank will definitely charge you for operating a current account. Some of these charges are not made known to the business until the business takes their bank statement. And so you go for your bank statement and you realize that the bank had made some charges on your account, which has reduced your balance. And because you were not aware, you did not credit your cash book accordingly to make your balance the same. And so these balances will not be the same because of the bank charges that was present in the bank statement. The next thing that I want to talk about is bank interest. Now, bank interest is also like the bank charges. Mostly it's the opposite, because the bank can also pay you interest on your account, which will be a plus to you. And so they will credit your account with an interest when you were not aware of the amount. When you were not aware of the amount that they credited with, you will not be able to debit your cash book. And so there will be a difference between the cash book balance and the bank statement balance. At the same time, interest can be a debit. They can charge you interest on overdraft, and that will be a debit on the bank statement. And so bank interest can be a debit item or a credit item. And so let us be careful. Let us look at whether the interest was for us or was against us before we will know how to treat it. But definitely, the point I'm trying to make for now is that bank interest can cause a difference between the cash book balance and the bank statement balance. And then I also want to talk about wrong debit and wrong credits. So wrong debit and then wrong credits. Now, wrong debit. Wrong debit is when the bank debits your account in error. And so they charged your account wrongfully. So maybe they were supposed to charge a customer's account. Someone bears a similar name, and instead of keying your bank account number into the system to charge, or keying the person's bank account number, sorry, to charge the person's account, they may just key your account number and key the charges and just charge you. And so before you realize, an amount has been wrongly debited to your account. And so when you take your bank statement, you realize that the balance on your cash book is different from that of the bank statement because there was a wrong charge on your account. The opposite is true with wrong credit. Sometimes you'll be there, an amount that does not belong to you will just come to your account, boom, just like that. So you can receive a credit balance in your account wrongfully as well. And so when that happens, your bank statement balance will be overstated and will be different from your cash book balance. And so that one will also have to be corrected as well. Now finally, there may be other factors. I'll talk about them maybe in the next video when we come across a question with those. But then finally, I want to talk about errors. Errors can be committed. So point 9, errors. Now as for errors, they can be committed by the accountant in the cash book, or they can be committed by the bank in the bank statement. Errors are errors, and there can be omission, misstatements, and wrong entries in either the cash book or the bank statement. And once there is a mistake happening, know that your balances will not be agreeing. Okay, so errors can be done in the bank statement, and errors can be done also in the cash book as well. And so when we are preparing bank reconciliation statements, we do correct errors. We are going to prepare an adjusted cash book or a revised cash book to reflect the changes that is to be made in the cash book, and then we prepare a bank reconciliation statement to reflect the changes that is to be made in the bank statement, so that the two balances will now agree. That is basically what we are going to do. And so when the errors are committed by the accountant in the cash book, take note that those errors should be corrected in the adjusted cash book. But when the errors are committed by the bank, those errors should be corrected in the bank reconciliation statement. When the errors are committed by the bank or in the bank statement, then those errors needs to be corrected in the bank reconciliation statement. And so when you are solving a question, you can see a lot of errors running through, and you'll be confused as to where to correct them. What I'm giving you, or the kind of guideline that I'm giving you now, is that look at the error. Is the error committed by the bank or committed by the accountant? If it is committed by the accountant in the business, it should be corrected in the adjusted cash book. If it is committed by the bank, it should be corrected in the bank reconciliation statement. But we are going to look at the effect of it, how it's going to be corrected in our next video, when we are trying to understand the format and how to solve questions. So the guideline that I'm giving you is that if the errors are committed by the bank, correct it in the bank reconciliation statement. If the errors are committed by the business or the accountant, correct it in the adjusted cash book. And we are going to look at the effect of them and try to understand them in our next video, when we are talking about the format and how to go about it. And then we are going to take a practical question as well. So for now, take this as the main factors or most of the factors that can cause a difference. And we can have a question where almost all these things are present, and so we have to take them into consideration, prepare an adjusted cash book, and then prepare a bank reconciliation statement as well. Alright, so remember to subscribe to the channel and then watch out for more videos. Thank you.